with more on the big sell-off is Mohamed El Erian, Chief Economic Advisor at Allianz. Mohamed, with the Dow closing lower by 831 points, you've been relatively optimistic about the state of our economy. What's your level of concern after this big sell-off today?
So, Sarah, maybe it's because I was on a plane earlier today, but I think of this as the market's changing engines while flying at a high altitude. What do I mean by that? We were a liquidity-driven market. We are becoming more a fundamentally driven market. That's good news over the long term, but we'll inevitably have lots of turbulence in the short term. And it's not simple fundamentals. This is in the midst of big divergence in growth and policy among advanced economies. So it's not surprising to me that we're seeing this. The only question is, why did it take so long? But it's not surprising me at all.
Mohamed, earlier in the week, you said the IMF was too bearish when it downgraded global growth. So do you remain as optimistic as ever on the outlook for growth, particularly in the US? And if so, is this just a temporary pullback?
So I do. I think the U.S. will be a 3% growth economy both this year and next year. The IMF has us at 2.9 and 2.5. But I also said, if you remember, that they were too optimistic away from the U.S. And that speaks to this key issue of divergence. When you get such divergent growth rates and policies, you start stretching markets. Remember, only yesterday, the yield differential between the 10-year Treasury and the 10-year bond was 270 basis points. That's enormous. So there's a lot of stress going on in the context of the U.S. picking up momentum and the rest of the world decelerating.
What about this move in bond yields, Mohamed? How severe does it look to you? And do you expect it to continue, given the economic backdrop and what the Fed is doing?
Yes, it's not going to be linear, but I would expect higher yields, and I would expect a steeper curve. And that's totally consistent with both what's happening on policies and the economy, but also what's happening to non-commercial buyers of long-dated bonds. They are slowly exiting. Their influence is being reduced, and therefore we should expect both higher yields and a steeper curve, but it's not going to be linear.
Mohamed, we got a comment from the White House that said the fundamental growth in the U.S. is still fantastic. This is just a one-day market move, and people shouldn't be worried about it. I'm paraphrasing that, of course. What will the Chinese reaction be when they see this type of share price decline? Does this even the playing field in terms of the negotiations between the U.S. and China?
Even is a strong word, Wilfred. I think what this does is it makes the Chinese say, well, it's about time. Our markets have been really beaten up when all this trade war rhetoric started. The U.S. was holding in. Finally, the U.S. is starting to react. So I think they're going to see this as somewhat better for them, but I don't think it fundamentally changes where each country stands in terms of negotiation.
Mohamed, the bears would say, they would argue with you and say, look, the fiscal stimulus can't go on forever, and the feel-good effect is going to wear off. The Fed is raising interest rates, which it typically does in a healthy economy, but that can also kill the bull market and the economy and lead to recession. We're heading into a trade war. Tensions have only escalated with China, tariffs on both sides, and cost pressures are rising for corporations. This is all starting to manifest itself in corporate America. So what's the main argument there?
So I would say to them, you have to distinguish between the baseline and the risk scenarios. Yes, there are lots of risks. You could get a policy mistake by the Fed. You could get a market accident whereby the technicals take hold of this market. And yes, we may end up in a trade war. I've put that probability at 25%. That's a meaningful probability for such a big event. However, if you look at the baseline, there's something striking going on about the U.S. It's not just about fiscal. We are seeing a pickup in, yes, fiscal spending, but also household income and also business investment. So you've got three domestic engines revving up at the same time, and that should take us through this year and next. Thereafter, you need a handoff from actual growth to potential growth. But for the next 2 years...
Sorry, continue, Mohamed.
Now, I'm just saying that for the next 2 years, growth prospects are good for the U.S.
Mike, clearly Mohamed is optimistic about the growth in the US. He mentioned technicals can take hold, but isn't too concerned about that. I mean, how likely is it that does happen, that technicals take over in the short?
I don't think anything that happened today would give you an idea that the market is fundamentally disorderly, that there's anything that's kind of adding some spring-loaded selling power in here. This was a pretty orderly adjustment in stock prices right now. It's painful. It was all in one direction, and it was a big bite all at once. I do think that bigger picture, I mean, if we're talking about technicals, I mean, I didn't see the credit markets freak out today. So a lot of the stuff that you would look for to say, oh, there's something that's mechanically wrong in how the markets are acting, I'm not seeing any of that. I do think, though, Mohamed brings up this great point that the U.S. seems like it still has this growth runway. And I would ask, actually, if the Fed is looking at exactly those same things and feels that that's exactly where we're headed, are they not just going to stay the course with the rate hikes? And I think that's maybe what the market's trying to acclimate itself to.
Mohamed?
Yes, they are. I think that the market has to realize this is a different Fed. The Fed put, as people like to call it, is way out of the money now. So I don't think this derails the Fed in any way. And I think we just have to get used to the fact that we have to stand on the basis of fundamentals and not on the basis of central banks. It's not an easy transition. It's going to be volatile, but over the long term, it's better for the health and the robustness of markets.
We will leave it there. Thank you so much, Mohamed El Erian.